Welcome to today's episode of the Deep Dive Credit Podcast, presented by Elite Credit Solutions. We are your trusted partner in affordable credit repair, proudly based in Tampa, Florida, and dedicated to serving clients across the entire United States. Join us as we explore the intricacies of credit management, share expert insights, and empower you with the knowledge you need to achieve your financial goals. Get ready for an enlightening journey into the world of credit. Let's dive in.
To the deep dive. Car insurance, it can feel like a maze sometimes, right? But today, we're diving into something that might not seem like a huge deal at first. Yeah. But it can actually really impact what you pay 6-month versus 12-month insurance policies.
Yeah, you'd be surprised how many people don't even realize that's a choice they have. And it really ties into a lot of things, like how much your rate can change, how flexible your options are, even like how much risk you're comfortable with.
We've actually got some really great resources for this one. Bankrate, Strickler Insurance, Experian, and the Zebra. So we're going to pull from all those to break down the things that actually matter when you're choosing between those 6 or 12-month policies.
We'll get past just the basic pros and cons. We're going to see how this decision connects to the bigger picture of how insurance companies figure out your rates.
Okay, so picture this. You get a speeding ticket, bummer, and then bam, your insurance jumps up. We've all been there. So the first thing to understand is how the length of your policy actually plays a role in those rate changes. Like most policies are either 6 months or 12, and that affects how often they're reevaluating what you pay.
Right, and Bankrate makes a good point that a shorter term like that means they're checking in more often, which honestly can be good or bad.
Okay, so let's start with the good. What's the upside of having them look at your rate more often if you've got a 6-month policy?
Well, let's say something good happens, like a ticket finally falls off your record. With a 6-month policy, you're going to see those savings a lot quicker. Strickler Insurance actually highlighted this as a major plus for people who are trying to improve their driving record.
Interesting. So the good stuff shows up faster, but there's got to be a downside, right? There's always a catch.
Oh yeah, for sure. It works both ways. So if insurance costs in general are going up, which let's face it, they often are, a 6-month policy means you could see those price hikes more often too, compared to if you were locked in for a whole year.
So it's kind of like agility versus stability. 6 months means you can adjust to changes faster, but you're also a little more exposed to the market going up and down.
You got it.
Yeah.
And that actually brings us to another big difference that a lot of these sources talked about, flexibility.
Right, because with a 6-month, you're not stuck with the same company for as long if you want to make a change.
Exactly. If you're not happy with your current company, or let's say you find a way better deal somewhere else, it's much easier to switch things up without having to wait a whole year. It's like if you're trying out a new streaming service. You don't want to be locked into some crazy long contract if it's not a good fit.
I guess the downside there is that you'd have to shop around and compare quotes twice as often. That doesn't sound very fun.
It can be a pain, yeah. Strickler Insurance actually warned about that. More renewal dates basically means more chances to forget about it and end up with a gap in your coverage. Not good.
Okay, so to recap the 6-month, more frequent changes, which could be good or bad.
Yeah.
You've got more flexibility, but also more admin stuff to deal with. So what about the 12-month option? What stands out there?
Well, Experian really emphasized this. The biggest thing is price stability. You lock in your rate for a whole year. That can be a lifesaver for budgeting because you don't have to worry about those surprise price jumps every few months.
So peace of mind and predictable payments.
Got it.
Great. But what about those times when, your rate could actually improve? Wouldn't a 12-month policy mean you're stuck with the higher rate for longer?
Yeah, that's the trade-off. Let's say you had an accident and got a surcharge on your rate, but it's about to expire. With the 12-month policy, you're stuck waiting until your renewal date to see that lower rate, even if it's months away.
So 12 months is kind of like a fixed-rate mortgage.
Yeah.
You know exactly what you're getting, but you might miss out on potential savings if the market changes.
Nailed it. And that's why it all boils down to what's right for you, What's your situation? How much risk are you comfortable with?
Right. It's not like one option is always better. It's about figuring out what lines up with your needs and what you're trying to do. It's kind of like deciding between renting and owning a home. They both have their good and bad sides depending on your lifestyle and your financial goals.
And believe it or not, we haven't even gotten to the discounts yet and how those work differently depending on whether you go with 6 months or 12.
Oh, yeah. The new customer discounts, the pay-in-full discounts.
Yeah.
Does that stuff even work the same way with both types of policies?
That's where it gets really interesting. And some of these sources actually had some surprising stuff to say about it. Like you might see a discount that looks amazing for 6 months, but it could actually save you way more over the whole year.
Whoa, okay, now I'm really curious. We've got to dive into those discount details next, but before we do, let's just take a quick step back. We've talked about the main differences between 6 and 12 months, the flexibility, and how your own risk tolerance plays a part. Anything else standing out to you from these sources so far?
Okay, so are you saying there's like a whole strategy to getting the most out of these insurance discounts? It's like a game within a game.
Exactly. And it all comes back to that, how long your policy is. See, some discounts, they only apply to one policy term. It doesn't matter if it's 6 months or 12, it's just for that one chunk of time.
Wait, so like a new customer discount that looks awesome for 6 months,
Mhm.
if you had a 12-month policy, you could actually be saving double that amount.
That's exactly what Strickler Insurance was saying in their guide. It's kind of like when you buy in bulk, sometimes you got to spend more up front, but you end up saving more overall.
So you really got to think long term, huh? It's not just about what the numbers look like right now. It's about the bigger picture. Like, are you going for the quick sugar rush or do you want the energy to last? And that long-term thinking, it's super important when we're talking about those 6-month policies and how they recalculate your premium more often. Bankrate and Strickler Insurance both mention that.
Right, because even if a 6-month policy seems cheaper at first, all those adjustments could mean you end up paying more over time, especially if, like, insurance costs are all over the place.
Yep, just like investing, you want the best return overall, not just the best price when you first buy in.
All right, so we've covered the basics, the flexibility thing, and the whole discount strategy. But how do we actually decide? 6 months or 12? What's right for a person?
Bankrate had a good way to think about it. They said start by asking yourself some questions. First, can you actually pay for a whole year up front? Because if you can, that pay-in-full discount on the 12-month policy, that could be a pretty sweet deal.
So if you've got the cash flow, 12 months with the upfront discount might be the way to go.
What if you're on a tighter budget, though?
Then those smaller payments on a 6-month policy, that might be easier to handle, even if you might miss out on those big upfront savings. It's all about balancing what you can afford right now with what's going to save you the most money down the road.
Right. And Bankrate also said to think about, are there any big changes coming up that could affect your rate? Like maybe a ticket's about to fall off your record, or you're thinking of getting a new car soon. Stuff like that can really shake things up.
So if you know something's coming up that could make your rate better, a shorter 6-month policy means you get to take advantage of that faster.
Exactly. It's like when you're planning a trip, you wouldn't book a hotel that you can't get a refund on if you weren't even sure of your dates yet. Right.
Yeah, makes sense. Got to stay flexible when things are changing. But what about people who just want to pick a policy and not think about it again for a while?
That brings us to Bankrate's last question. They said, think about how comfortable you are with your rate maybe going up. If you really like to know exactly what you're paying every month, that stability of the 12-month policy, that might be worth missing out on some other stuff.
So it's about knowing yourself, too. Huh. Like, some people are okay with not knowing what's going to happen, and others really need things to be predictable.
Yep. It's about making your insurance choices fit with your bigger financial goals and how you like to do things. And that's why all these sources were saying you got to get actual quotes. That's the only way to know for sure.
It's like trying on clothes. You wouldn't just buy the first thing you see without checking how it fits and comparing prices.
Exactly. And every quote you get, they're making it just for you. They're looking at your driving history, where you live, your credit score, even what kind of car you drive.
Hold on. My car makes a difference in my insurance. What does my car have to do with how I drive?
That's a great question. And that's a whole other piece of this car insurance puzzle. Turns out the car you drive can really change how much you pay. It all comes down to risk.
Okay, things are getting interesting now. So it's not just about 6 versus 12 months. There are all these other things that insurance companies look at, and we've only just started talking about them.
You got it. We've tackled the whole policy length thing, but now let's dive into those other hidden factors that affect your insurance. Things like where you live, your credit history, and yep, even your car.
All right, bring on the hidden factors. Let's get deeper into this.
Mm-hmm.
All right, lay it on me. What does my car have to do with my insurance rate?
Okay, well, think about it. Like a brand new sports car, that's going to be a lot pricier to fix than, say, an old sedan, right?
So that makes sense. So the insurance company is thinking about how much it'll cost to fix my car if something happens.
Right, exactly. It's all about risk. A more expensive car means a bigger potential payout for them if you get in an accident or it gets stolen.
So it's not just about me and how I drive, it's about the car itself, too.
Exactly. And it goes
Yeah.
beyond just the price tag, too. Strickler Insurance mentioned this. They said sportier cars tend to be associated with, drivers who maybe like to push the limits a little,
Huh.
which obviously could mean more accidents.
So it's like the double whammy. The car's more expensive to fix, and the people driving them might be more likely to crash.
Yeah, basically, they're looking at all the data, trying to figure out the risk based on trends and all that.
So bottom line, if I'm cruising around in a fancy sports car,
Yeah,
the insurance company is going to see me as a bigger risk, and my rates are going to go up.
pretty much. And there's another thing that plays into that whole risk calculation, too. Location. Strickler Insurance mentioned this, and so did a few other sources.
Location. Wait, what does where I live have to do with my car insurance?
Well, if you're in an area with a lot of crime or a place where accidents happen all the time, statistically, it's riskier to own a car there.
So if I live in a city with crazy traffic or maybe a lot of car thefts, my insurance is going to be higher even if I'm like the safest driver ever.
Yep. It's not just about you, it's about the environment you're driving in, too.
It's like they're making this map of risk, where
Right.
some areas cost more to insure than others.
Perfect analogy. And another thing that gets factored into that risk map is your age.
Right, right. Younger drivers, they always get hit with the higher rates.
Yeah, because statistically, drivers who are younger and haven't been driving as long, they're just more likely to get into accidents. Experian mentioned this in their article.
So basically, the more years I've been on the road, the less of a risk I am.
Exactly. It's like anything else. The more experience you have, the better you get, and the less risky you seem to the insurance companies.
Okay, starting to see how all these pieces fit together. Now, what about that whole credit score thing? I've heard that affects car insurance, but that one's always confused me.
Yeah, that's a good one. And Strickler Insurance actually addressed that specifically. They said that in a lot of states, having a good credit score can actually get you lower insurance premiums.
Wait, hold on. How does my credit score? Like how well I manage my money.
Hmm.
How does that have anything to do with my driving?
So there have been studies that show a connection between your credit score and how responsible you are in general. And insurance companies, they figure that translates to being more responsible behind the wheel, too.
So if I'm good with money, they think I'm more likely to be a good driver too.
That's the idea. I mean, it's not a perfect system, but the stats seem to back it up.
I can kind of see the logic there, even if it's a little weird. Okay, what about my actual driving record? That one seems pretty obvious.
Oh, yeah, for sure. Strickler Insurance and Experian both said that's one of the biggest things. A clean driving record. No accidents, no tickets, no nothing. That's the best way to keep your insurance costs down. It shows you're a low risk.
Yeah, makes sense. The safer I drive, the less likely I am to need to use my insurance. Which is good for them because they don't have to pay out any money.
Right. It's all about proving you're a safe and responsible driver.
Okay, so we've got the car I drive, where I live, how old I am, my credit score, my driving record.
Okay.
It's like all these things get thrown into a pot to figure out my insurance premium.
And one more thing, too. The Zebra brought this up. Annual mileage. The more you drive, the higher your chances of getting into an accident.
So if I'm commuting a long way every day or I'm always on the road for work,
Yeah.
my insurance is probably going to be higher.
Yep. It's pretty simple, really. More miles equals more chances for something to go wrong.
Makes sense. So it's not just how I drive, it's how much I drive too.
And some companies actually give discounts if you use those telematics devices or apps that track your driving.
Oh, interesting. So even if I drive a lot, if I can prove I'm being safe about it, I might get a break on my insurance.
Exactly. It's all about knowing what's out there and using it to your advantage.
Wow, we've gone from talking about 6 versus 12 months to uncovering this whole crazy world of car insurance and all the things that affect it.
And we've just scratched the surface. There's always more to learn about this stuff.
Sure.
Insurance, personal finance, all of it.
Well, everyone listening, we hope you've enjoyed this deep dive into the world of car insurance. We've definitely learned a lot, and hopefully you've got some good info to help you make smart choices about your own insurance.
Remember, be informed. Ask questions, shop around, compare different companies, and really understand those factors that affect your rates. You've got the power to find what works best for you.
Until next time, drive safe and stay curious.
Another insightful episode of the Deep Dive Credit Podcast, brought to you by Elite Credit Solutions, your go-to resource for affordable credit repair across the United States. We appreciate you joining us today, and we hope you found the information valuable and empowering. If you're ready to take control of your financial future, Don't hesitate to reach out to us at 813-317-6776. Additionally, don't forget to like today's podcast, share with your friends on social media, follow us, and subscribe to our YouTube channel to stay in tune with future updates. Thank you for listening. And until next time, keep striving for excellence in your credit journey.